All right. Good night, people. I am live. I have just shared the link. Let's see how many people jump in and join me. Good night. It's been 2 weeks since I've been here. And guess what? Keeping to schedule. Um, Sharing the link. Yeah, a little slow on the uptake. Have noon, it was all quiet on the front, and then all of a sudden banks were popping off left and right, and it was like, what's really going on? There was a lot of chatter in the crypto community. I am on crypto Twitter. I don't post much there. I'm also on LinkedIn. On LinkedIn Sunday night, I posted what my views were in relation to that. I'm kind of buying a little bit of time because I'm here a little early, but I posted my views Sunday night on LinkedIn, and a publication, Worldwide Money Laundering Report, actually asked for me to republish that as an op-ed. So that happened yesterday in terms of the risks that I saw that were materializing, because a lot of people have been conflating the banking collapses with cryptocurrency, and it's not that. But of course, if you don't know, you don't know. So one of the things that would happen is that people will be under the misguided impression that this is just a fintech issue that is now bleeding into banks, and that's not the case. I've also had people asking me questions one on one, and I said, you know what? Why not a live? And why not the topic of this live? It's about do. So I am in the place where, let's get it. Looking for people to jump in and join. No one yet. Where's everybody tonight? I know in the BVI, it's been announced that we have elections in about a month. So there's a lot of campaigning that's going on, and so you have people who are in that particular space, who are, of course, they've announced their candidacy, and they are focused on that. I'm trying to get people in. People, come on in. The water's fine. Thank you. I see you coming in, and I see the thumbs up. So that's great. All right. So let's get into it tonight. Right. So we have a fair amount to talk about. I'm going to try and do it in a logical manner. Thank you so much for joining me, and let me get started officially. So good evening, good morning, good day, everyone. Thank you for joining me from wherever you may be on the planet. I don't think I have any viewers on the International Space Station yet, but we have definitely checked the box with that Chinese proverb that goes, may you live in interesting times. We have been checking that box for 3 years solidly now. I do believe that every single day from here on out, there will be a lot of revelations, a lot of developments in a lot of different spaces in the world. But my area of focus, my passion is in compliance, and we're going to cover it tonight. I'm definitely here for it. I'm definitely here for your questions. So it is important to, if you have questions, definitely ask them. You get to put a regulator in a hot seat. Come on, people. And while I'm not actively regulating, no, I'm still with a regulatory authority. It is one of my passions to explain things to people. And so it's been fun. And I think it's going to continue to even get more exciting. So if you're new to the channel, welcome. Thank you for joining me. My name is Simone, and I've been a financial services regulator for over 21 years now. So, it's been a long time. I will admit there have been times when it felt like a prison sentence. I'm going to be transparent. And I've been in that career, I've been tremendously fortunate that my experience has spanned almost all regulated sectors. So I've supervised banks, insurance, mutual funds. I've done, that was the early days of my experience. And most of my career was in relation to trust and corporate services providers, which has a lot of content around the beneficial ownership issue. But I've also been heavily engaged in AML CFT for over a decade. I would say about 15 years of that time. AML CFT was also in tandem I saw some issues in terms of corporate governance, so I made sure that I got some exposure in that. And I've had the opportunity, really huge opportunities, to deliver presentations at conferences, to speak at plenaries, FATF, and other international standard setters. More recently, I gave a TEDx talk for TEDx Road Town. Now, why all of that background? Because if you're new to the channel, or even if you know me and you might not know the depth of work that I've done, it is to give you context and a part of the reason for this channel and why I feel like I can help offer a bit of clarity to this. But it's also a passion of mine helping compliance professionals that grapple with a lot of the dynamic issues in the regulatory ecosystems. And compliance professionals don't necessarily only identify as chief compliance officers or money laundering reporting officers. In the last 5 years in particular, I've been having a lot of discussions with people in the fintech space and innovators who don't speak regulator, but want to get some idea as to how to engage, because it's new for them. And so it's also to help people not beyond innovators who are not working in compliance to understand how certain compliance related issues impact you. So you would have seen some of my videos from like almost 2 years now with the basics, like, what does it mean when the bank asks you for your passport copy and everything else. So it's issues like that that I have been trying to help with. And hopefully I've added a little clarity. Now, before I get into it, I also want to say a huge thank you. The subscribers continue to go up. To the new and old subscribers, thank you for joining me on this journey. And whether you're tuning into the live or you've cherry-picked prayer content and this is your first live, or you've just had a good time with my shorts, some of them are quite funny. I think they're funny. I've heard they're funny. I'd like to think that they're entertaining and educational as well, because this is about, entertainment as well. Thank you for the support. The live is about to get going. So if you know somebody who would be interested in, having a different vantage point on all the current issues, who you think would benefit, share again, share with your network. And thank you for joining me. So with all of that being said, let me get my disclaimer out of the way. I am a financial services regulator. I am not a lawyer and I'm not a professional advisor. And the views on this channel are definitely all my own and do not represent the views of any regulatory authority or international standard setting body. Now, with that out of the way, let's dive in. So the current issues in the banking collapses. Whew. Literally a little more than 72 hours. It's not been a week. There have been no less than 4 banks in crisis. I didn't even want to look an hour before this live because I was updating information at periods like early this morning, because there are things that are happening on both sides of the planet. And if you've been loosely following the news, those banks in the US ecosystem are Silicon Valley Bank, so SVB, Signature Bank, and Silvergate Bank. Those are US centric, but SVB and Signature have presence. They have banks so separately licensed in the UK or EU or both. And then, of course, you had on the other side of the pond, EU, UK side, Credit Suisse. Now, the triggers of these individual bank failures and or crises, because Credit Suisse is still there, and some of the other banks, they're still there and to be acquired, and it's a very live space, have failed because of different elements. But there are a few common factors that are, in my opinion, are what made the failures more likely to happen in this ecosystem. So what are those things? Certainly, you have a number of issues, and I am not going to be pretending to be a Monday morning quarterback, is the term that they use sometimes when people are looking at football, American football, to see what went wrong. When there is a crisis in a firm, it doesn't matter whether you're regulated or not, but if you are regulated, bank, investment house, insurance, whatever, what, when, and how you communicate is often a very major factor. And we are going to get into what the drivers were for those bank collapses in the US system. But messaging is one of the important things, because if there's silence, sometimes that triggers more panic. Now, US banking ecosystem, from my vantage point, I have no inside knowledge, but I have signal certain things to me. There are a lot of moves that are happening. And outside of the collapses, a lot is happening with regulatory authorities in the US. It seems as though they're trying to bed down who is going to claim the territory as it relates to regulating different types of crypto businesses and is the scope of regulation. And there's this search for the term, regulatory clarity is one of the biggest cries of innovators that are exposed to US ecosystem over the past 5 years. But in other parts of the world, they've been putting in the work on providing clarity, regulating, guardrails, and moving on. And leadership from the regulatory community is being evidenced in public spaces. So if you know where to look, you would be able to see that. But a lot of people don't necessarily thumb through the publications of international standard setters or other bodies. But in the Caribbean, we tend to have to be, and if you're in the regulatory space, we have to be very focused on these developments because they impact us. And we have our own challenges where in the Caribbean as a region, and we're going to get into a bit of that too and how all of this is connected. We look to innovation to try and make sure that we could leverage all of our skills and talents to compete on a global stage. But if you have any doubts about the Caribbean's ability to innovate, just look up the first CBDC and you will see that it's a Caribbean country, which is the Bahamas. And they've been in the news a lot with FTX. And a lot of people have a lot of things to say, but don't recognize that that is a very, very, very well regulated jurisdiction. So, again, if you don't know, you don't know, but I am here to hopefully help you know where to look, what certain indicators are and what things mean. You have other places where you have like GFIN, so the Global Financial Innovation Network, which sits under the UK's regulator, the Financial Conduct Authority. The members of GFIN are a number of regulators from around the world, and they include Caribbean regulators. Again, don't take my word for it, look it up. And I don't have the link in the description for that, but I can definitely add that. And regulators have been putting in the work. But in the US, the water seems to have been muddied quite a bit. And there's a bit of political interplay in terms of how the US is going to come down and not come down like to drop a hammer, but in terms of forming legislation for the fintech space and for innovators. But it is a painful process. And this is one area where the rest of the world is moving far ahead of the US. Now, we're getting to the bank failures, but one of the issues that impacted the Caribbean as a region in the past decade is also at play with the US bank failures, and that is de-risking. Now, de-risking has evolved in a definition, and I think it's one that's flawed. Basically, you're eliminating the risk by removing something from your operation. So in the Caribbean context, we had Caribbean banks that were removed from the list of banks to which US correspondent banks mainly provided services to. And that reduced their risk, but it actually increased the risk, a lot of other risks overall. And for banking, de-risking by correspondent banks left a lot of institutions with less access to the global economy. So think, trade between companies. What does it mean for you as an individual? If you live in the Caribbean, you pay a lot more for wire transfers and money transfers. It takes longer for the money to get there. And the cost of compliance goes way up for everyone. It also pushes money on the ground and creates fertile ground for shadow banking to occur. It creates fertile ground for other financial crimes to occur because people are looking for facilities that are now evaporating out of the Caribbean ecosystem. Now let's look at those US banks and de-risking. Those banks seem to be the banks that addressed a market that is not being well served by other banks. Other banks are not taking on what they see as risky business in innovators. And the sad commentary is that, people see fintech and it's like, ooh, we get a little out of sorts. But it might be just a payment system. Are you going to not bank MoneyGram or Western Union when you have an innovator that is essentially looking to provide similar services, but they just have a name that connotates innovation in their business? But there's a need, again, it comes back to this need for clarity. And the three banks that failed were among the very few banks that facilitated innovative business. I am going to leave Silvergate out of the equation for the time being because that had a lot of ties with FTX and Sam Bankman-Fried. Banks' business models will evolve in time, and they have to make sure that they're positioned to fill the gaps. Smaller banks are the ones that sometimes will take on risks. But one of the major risks that is here contributing to the bank failures is concentration risk. Because these smaller, in the US standards, focused on providing facilities for innovative businesses, fintech businesses, they developed a concentration risk. So they had a lot of these businesses as their clients. And if you had a systemic risk impacting that sector, FTX, Voyager, you had Celsius, you have all sorts of things happening. Of course, there's going to be a knock-on effect. No, banks monitor concentration risks and other risks. So it's not like this happened and nobody's paying attention, because banks monitor it, but regulators also monitor it. Banks have been subject to regulation for over a century, and every country has similar elements because they're based on international standards. BCBS, so you have banking core principles that all regulators will adopt into their legislation. So this is why I can sit here in the British Virgin Islands as a regulator with over 2 decades and having perused banking core principles, applied them, look at, gone to trainings and things, and for like Basel 3.0, which is, again, regulatory speak, we don't need to get down those rabbit holes. But banking supervision involves a lot of ongoing oversight in good times and especially in bad. But sticking with concentration risk, as a sector, fintech businesses are relatively new, but it doesn't mean, from my perspective, that they're more risky than well-established sector. The difference is that other well-established sectors have had decades for their risks to be poured over and typology reports to be developed. But why is it that some banks are more unwilling to take on the risk? Again, there's a gap in terms of what disclosures are needed, and then regulation is continuing to evolve in the space. So it's almost like a moving target. And some banks are like, listen, we might not want to take on this business because we're going to be thinking we're doing it right, but then we get fined by the regulator. So, the lack of regulatory clarity and other concerns regarding possible enforcement action by their regulators is a very real concern. And some institutions just don't want to take on that risk. So another risk that is definitely in play is in relation to liquidity risk, right? So liquidity risk, and I will say no, because we're focused on the US side of the market, driven by the Feds raising interest rates quickly. That hits all banks that hold long-term US Treasury bonds. No, this is not to say all banks are going to fail. That is not what I'm saying. You just don't panic. Remember that interest rates a couple of years ago are basically at zero. And US Treasury bonds, for accounting and for capital and liquidity recognition purposes, are considered basically the same as cash equivalents and highly liquid. So you can trade them. But because interest rates were raised so quickly, any institution holding a long-term bond would be worth less than one that was issued now in a time of higher interest rates. And this is also where we get into, you could look up interest rate risk, but I'm just boiling it back down to liquidity risk for, a general audience. And I'm trying to be very plain spoken on this, right? But back to the banks. SVB held a lot of US Treasury bonds that were issued in that low risk time. But in the wake of a number of reports and concerns in relation to the fintech space, there was a run on the bank. And the term run on the bank, it's almost the equivalent of yelling fire in a crowded theater. People will argue, yes, we have free speech, but you have free speech, but you can't incite panic. And so if somebody is known to willfully create a run on the bank, that's actually a crime. I don't know any country where it's not a crime. But a run on the bank is where you have everybody trying to withdraw their money at the same time because they feel the bank is going to go down. And when that happens, regulators have to step in very quickly, because sometimes even the perception of a failure can cause a bank to collapse if you have a run on the bank. As for SVB, they had a UK presence, so a separate license, separately incorporated legal structure, but related probably by either common ownership. They might have common group directorship, and to coordinate their stratagem. So it's very similar on the different sides of the planet. And that bank was acquired by HSBC for £1. Now, that means that HSBC essentially is going to be taking on all the debts and all the liabilities and all, everything in relation to SVB, but it continues to be a going concern. And the banking space is very hot. And like I said, I didn't even want to look at the news in the last hour because everything was coming out like, current. So while I'm speaking, things could be going on and there could be deals that are being updated. And there are other risks, of course. There's a lot being said of systemic risk. But if you want me to dive into some of those things in another live, just comment, let me know, or ask. Let me see how, if I could manage to fit that in. But social media have caused what I would think are faster reactions in relation to these firms in crisis. And I say firms and not banks because you've had a lot in relation to cryptocurrency exchanges recently. And with the FTX case, there's a lot of discussion in relation to that. But, talking about people are like, crypto is the devil. That's not the case. FTX is based on the information that is out in the public domain and based on where evidence is pointing to was a plain out simple fraud. It could have been a fraud for a furniture store or whatever the case may be. But it just happened to have been a fintech platform. But that was straight up fraud. That had nothing to do with the fact that cryptocurrency was involved, but the bad intent of the controllers. But this is the age we live in. Social media tends to exacerbate things. And again, this is why I started out with when you are in crisis, it is important to communicate and so you need to have a plan beforehand so you know what to do, because somebody's going to say it for you. And if you're too quiet, it actually gets more attention, and it might not be the type of attention you want as a firm in crisis. And if you're in compliance, that's one of the things that you could look to as well, having a communication plan to try and address some of these issues to make sure you are the one that's getting your message across and not have someone else do it for you. It's really important. So in the US, a lot of cries for regulatory clarity. And guess what? It really does have to come from the regulator of whomever the relevant country is. And the US regulatory ecosystem, like I said, has a lot going on. But what I will cap here with is that there's a lot of work that needs to be done for that fabled regulatory clarity. The good news is that crises can get change going, and in some accounts executed faster than if there wasn't a crisis. So no, I don't have any inside information. I don't know who's going to put out what, but that tends to be the nature of the beast. And I'm going to be watching this space just like everyone else. Credit Suisse. Now, to touch on Credit Suisse for a moment, that's a bank that has had some major issues in the last few decades, actually. They have had scandal after scandal over the past few years and few decades, past few years, and that has been, one of the things with Credit Suisse. You can look up Credit Suisse scandals, and they go back at least maybe close to 20 years themselves, probably far back, but since I've been in the space. Now, as a takeaway, I want you to go with that about the economy, global economy, and why would that be? The 2008 global financial crisis taught us a lot, but some lessons seem to be a little harder to take on. After 2008, businesses also sought to reduce their risks by seeking multiple accounts, but opening business accounts with banks, even in the best of times, is not easy. And I keep hearing that from around the world. For fintechs, it's even more of a challenge, I'm told. And what we are seeing is that concentration, liquidity, and all the other risks can go both ways. So yeah, it's one of those spaces where you're going to have, there are going to be more discussions in terms of calming and mitigating against those risks. And there's a lot of work that is in progress. Now, if you're enjoying the video, make sure you hit the thumbs up, help with the algorithm. I'm trying to do my YouTube thing here, people. So, and again, if you're just joining, thank you. Make sure you share. because I think, it's quite a bit. So the next topic, Credit Suisse. So Credit Suisse, they have been basically, they've received what is a capital injection, I believe it was, to the tune of $54 billion from the Swiss Central Bank. So they were looking for assistance to help shore themselves up. So capital, when you inject capital into a firm, it helps them cover and weather operational stressors. So they had, was their stress triggered by fintech? Again, no. It just so happens that the timing feels like it was around the fintech issue, but it was not. And again, in the EU and the UK and other European countries and in Asia, you don't have the issues as intense with banks shutting out, de-risking innovators. Regulators in a number of jurisdictions have given clarity. So banks do have their crypto clients and they in different parts of the world, but also in terms of regulation, a lot of them have moved far ahead of the US. The rest of the world is just moving on. So now talking on to the second topic, friction between corporate governance and compliance. It might seem like it's unrelated, but it's actually not. From the vantage point of banking failures and Credit Suisse needing injection and regulators needing to give more clarity, you will notice that it's both fintech and traditional financial services, or they call it TradeFi, continue to struggle with compliance. You would have seen Kraken, Coinbase, all sorts of people getting fines for AML failures. But just type in AML failures into Google and hit the news search and see what comes up. And you will see traditional financial services institutions keep getting hit with penalties and enforcement action. And why is that? Leadership of a firm, whether you be innovative or traditional financial services, they have a vision of what the firm wants to accomplish. We're in business to make money. And some leaders are switched on that there's a need for the compliance function. Fewer have a full appreciation for what that actually entails. Now, how can I say this? I don't have to have insights into all firms and all sectors on the planet. The indicator is exactly what I told you to Google, all that enforcement action for compliance failures. And it's not necessarily even just Google. These compliance failures include AML, CFT failures. Those are the ones that get the sexy headlines, money laundering happening here. This account was found in breach of sanctions. These people were doing these bad things here that allowed for bad actors. I want to say TF. So, what TF stands for in AML, CFT world, to do some bad act. But there are other enforcement actions that may not get the press, but they're also published. Regulators tend to publish most enforcement action on their websites. So if you trawl a few websites from different places, you would see who was subject to recent enforcement action. And that's how you get a sense as to whether people are getting compliance right or not. And, you just pick at random a couple G20 countries. Now, if you're not in the space, compliance function does rest in the hand of the chief compliance officer. But the compliance function is the responsibility of the leadership, and that's the board of directors, delegated to the compliance officer. And let's not forget that directors have a fiduciary duty to act in the best interest of the firm. And acting in the best interest of the firm is not just about making money. It means that the best interest of the firm is to comply with laws and regulations, and not just financial services laws and regulations. Pay your taxes. Make sure you're properly registered with whatever trade association that is required in your country. And it's not that those things are opposed to making profits. Nobody is going to say, well, I don't want to pay my trade license because I want to save that money to make a profit. No, it's a requirement for you to do business in whatever jurisdiction, so you have to do it. But this is where some of the friction can and often does come in. And when times are good, everybody's happily on board that train. Operations are running smoothly, people getting raises, compliance detecting and preventing real threats that could derail the business. It's a smooth ride. But even in good times, directors are looking for more opportunities, and there's nothing wrong with that. Even if it's innovative, there's nothing wrong with that, unless they do it without their compliance resources. And that tends to happen. They're not involved in the conversation for new business. So new business channels, compliance not involved. I'm just having this drink with a colleague who's telling me about this new outlet market, innovative product service. We could reconfigure this. We could get another 20% market share. Sounds great. Changes to existing business practices. There's and then, you might want to say, well, boss, this particular line of business is a problem. We should probably consider cutting this off. There's a resistance or reluctance to do that because, it brought in good money and there was never a problem with it. This is where the friction starts to come in. And there are times when the risks are present and unknown, or worse, present and known, and the firm still continues, and it's almost like you're playing a little Russian roulette. Directors, managers, and other C-suite executives often make pivots to keep the business going, but forget that Russian roulette. Directors, managers, and other C-suite executives often make pivots to keep, and as Virgin Islands sometimes would say, what start bad can't end good. It seems like a small thing, but these are all the points that opens up a firm to the spots in their compliance framework. Now let's go a step further, and I promise you it's all related to what the fintech. Your marketing. The firm spends a lot of money to market to attract new clients. Some firms go get their statements checked with lawyers and with PR firms, and everything feels great. It's sexy. This will bring us more business. And you go launch these ads without checking with compliance. That's another weak point, another point of friction. Why? That savvy ad may actually trigger a regulatory flag because it may be at best in breach of law. And that's one of the areas where you might see a lot of publications on the Financial Conduct Authority's website. Or in worst cases, it gets the attention of a competent authority, and not necessarily just the director, it might be law enforcement, where you have, a massive breach. You've breached something. And guess what? When the questions come from that competent authority, who is asked to answer it? It's not the marketing manager. It's not the operations manager. It's not the CEO. It's the chief compliance officer who was not involved. And in a lot of these cases that I'm looking at with the banks, I am also diving in to see what were their compliance resources. What was their, did they have a chief risk officer in terms of the size of the organization? And the case studies will be done in terms of forming up what was their compliance spend. And we're going to get into how fintech, the future of fintech, they're throwing a lot of money behind compliance because it's one of the areas that they're recognizing more and more. I mean, I heard something anecdotally today where when you do, what is the saying here? If you know, you know. And if you don't know, you wonder. There are a lot of people who think they know the whole scope of regulation. And in relation to a particular law that was championed by a former politician whether it was a Treasury Secretary or something way back in the US. And there were innovators who thought that this was actually a person who sat on a board of an institution and not necessarily that it is who the act was named after. So, it's like having awareness and that shows you're a complete compliance novice if you don't know some of the core underpinning legislation that is involved with compliance, and you're a mixed company saying these things publicly, and it shows that compliance is not involved with the discussions that chief executive officers, chief technology officers are having in the space that let those in the regulatory ecosystem know that you don't quite get it. So, and I mean, that's a perfect segue for me to get into my little blurb before I jump into the last bit, the future of fintech and regulation, because it's coming. Some of those issues I just pointed out are going to be topical in the coming days. And it's going to be an area where I dive into more deeply in my membership. The membership is called Chasing Compliance, and it's designed for compliance professionals. So if you identify as a chief compliance officer, an MLRO, chief risk officer, compliance administrator, sanctions compliance professional, all of those things, another job title, there's information below. And one of the few things that I've seen in my career are compliance professionals the world over who have attained qualifications in compliance. And just this week, I saw an online offering for virtual learning that covers less for a lot less than some of the offerings I have for a lot more. Now, someone in my network sent it to me, and it was, it was curious, an online learning course that was 2 to 3 days for about 3,000, a little more than $3,000. It wasn't for this side. It's based on the other side of the planet, so it wasn't quoted in USD. And one day of that was to address KYC or know your customer. So you could say, let's cut it in a third. It would just be over $1,000. Now you can spend that or more on some of the offering, and once you're finished, that's it. You're on your own as a compliance professional, and you figure it out. So your option is basically to spend between $3,000 to $6,000, or to spend $49 on a membership. And even if you spend $49 on the membership and buy all of the online courses that I offer, you'd still spend less than $1,400 in 12 months. And value there, it is that people to be able to access it and have a place where they can ask questions. So you're not on your own, because nobody ever said, compliance is easy and I can knock it out in just one go, and that things don't evolve. So, and then the new extension of the Chasing Compliance membership for compliance and crypto is $19 a month, and there's a free 3-day trial. 2 weeks ago, we did the first webinar. So it was launched this month, and we did the first webinar on the FATF travel rule. This Saturday, we are going to be looking at DeFi, the DeFi space. And in another 2 weeks, we're going to be having a webinar on Fintech engagement with regulators. So if that's something that interests you, check the description below for more information. You could definitely get it there, or follow me on LinkedIn at Ignis Solutions Limited, or directly. Now, another great segue. My thoughts on the future of fintech and regulation. If you followed me on social media for a little bit of time, you would know that I am invested in cryptocurrency. And I've disclosed this in my LinkedIn post of Sunday. I have 1 degree of separation from Signature Bank. It was the bank that was the gateway for me to get into one of the cryptocurrency exchanges that I used to purchase my cryptocurrency. I have past YouTube videos where I talk about, what's my biggest how much, not how much, I don't ever put out how much, but my biggest crypto holdings, what crypto I have invested in, some of the I've even done misconceptions on cryptocurrency and fintech. But I've also had other engagements with innovators in the past, presented to different forums. I've presented to devs, so developers in the fintech space, people who are looking for real life applications for NFTs, DeFi platform creators. I've had conversations with all sorts in the innovative space. And I am not saying that I'm an expert in all things fintech and regulation. I am not. My expertise lies in regulatory constructs. The bank failures were not driven by cryptocurrency or fintech or by exchanges. But what we are seeing is that with the bank failures, more money and not less is flowing into crypto. But crypto is not the fintech industry. So beyond the cryptocurrency exchanges, you have the DeFi, the NFTs, DEXs, DAOs, digital payment systems. You have the tokenization of everything. I'm probably going to miss something, but there's a lot going on in the space. So it's not just crypto. And a lot of people will just term it that. So that's one of the other areas that if you're not aware of it, and this is just again, my channel is designed for a broader audience, so you get some understanding. These are some of the areas that are still being developed and successfully being developed in other parts of the world. Some things are live, some things are beta tested. But one of the few elements that the fintech industry still need to bed down is the same thing that traditional financial services still needs to bed down. KYC or due diligence. It's not a one and done. It's still an issue. Regulators have cracked down hard on a number of exchanges. And Coinbase had come to a settlement because of their poor AML systems, anti-money laundering systems. And the settlement was, $100 million. but half of that was the fine and half was what they had to commit to use spending to build up their compliance programs. And one of the things that stood out was that for me as a regulator, basically they were saying that customer identification, so KYC, was, they used the words immature. Like that's basically saying, like, did you come out of primary or elementary school even to understand what this means? And that is really an insult to a financial firm, fintech or otherwise. That is an insult. Like KYC should be one of the basics. I have a new course on that. It's in the description below. But why is this? Because based on my observations and discussions and just watching what's going on in the space, they think that KYC is the whole kit and caboodle of AML CFT compliance, and that is like the last thing you should think. Now, Binance has also been in the news, and they've hired top tier talent. Like I've heard it said, like the compliance dream team to address their compliance issues. And other firms are now pushing to increase their compliance resources. And it is one of the spaces, again, I've said this, maybe not the last, but prior lives or prior forums. Compliance is going to be one of the most in-demand jobs on the planet. It is that dynamic. And I had the conversation with a colleague recently. We were talking about AI applications and certain jobs going away. AI ain't gonna get to compliance. There might be certain rote functions, but it's not necessarily something where you can apply the machine learning for every little bit of it. There will still be a need for human brain engagement on a particular issue, several issues as it relates to compliance. So the acquisition of compliance talent is just a part of the equation. And if you're in the industry, congratulations. It is sometimes a thankless job, but guess what? There's some job security in that. And the leadership of a lot of firms, you are there to make sure that you advise on the risk, you set up the the compliance framework, you implement it, you test it, and you have your reporting and disclosures to the board of directors, management, and all of that. But if you see something that's like glaring, make sure you communicate it, make sure you document it. Again, contemporaneous notes are not just for James Comey. Document it, make sure it's filed, and move on. And then, but how you communicate things, just like in crises with firms generally to the public, internally, how you communicate things to your board, to your management, to staff is also equally important. So don't just take it as you're an authority onto yourself and you can do as you like because you see it as a compliance issue and that, they must follow you. Because again, it was delegated to you. It's not yours in the grand scheme of things, and it may sound painful. It's not yours. And so that's one of the areas where I think there needs to be a recognition that everybody has to work together. So don't bring the friction on yourself if you don't have to. So one of the other concerns that has popped up is that, with the banks that have failed in the US, all of them were the on-ramps for crypto exchanges. Well, not all, but they were on-ramps for many of the major crypto exchanges. But those on-ramps will not disappear and banks will still have a role. And there's a lot to be said. But there's a lot of developments that are also happening in relation to digital payment rails happening right now. The Bank of International Settlements is BIS. It's one of the bodies that I'm looking at, but there are other groups. I mentioned GFIN earlier. There are other groups that are working together with innovators. The shock to the banking system in the US will likely have the effect of giving fuel to the work of innovators around the world, I think, to get to completion on their respective projects, because out of crises also comes opportunities. So what else do I need to see? I've been going for quite some time, and we've covered a lot in this live, and there's so much more to dive into. Still no questions, and you can ask me the questions afterwards. Like I said, there are other platforms that you can find me at. But before I go, make sure you visit www.ignussolutions.com/storefront, because there's a free tool that's available there for you if you're in the compliance space, free downloadable. And if you don't have a system to go to, make sure that you consider consider just reading up on some of the free content. I've had blogs on some of these same issues with alternative finance and payments and regulatory regimes. And I'm still tilting at the windmill of a regulatory hackathon. So who knows? Maybe I get to give an update on that in the next 2 weeks. About 2 weeks, I'll do another live. But questions? Questions? No questions. Well, I am gonna make sure that I get myself ready for the next live. Who knows? I might be able to do one next week. But don't forget to check out the information in the description below. If you're interested in joining a membership, that actually works out to a lot less than some of the training, and you can get exposure to training. Oh, and the online courses that are available by Ignis, they do come with a certificate. So you can actually, if you need something to prove that, you've undertaken this training, that is provided as well. But beyond that, feel free to reach out to me if you need any more information on a new course, KYC, the Complete Compliance course. If you need a downloadable, if you want to connect with me to chat, if you want some other engagement, I am here to help make sure that you have a better compliance journey. And if you're tuning in live, thank you for tuning in. I really hope you found today to be valuable. And all my other posts and lives, I've tried to bring some kind of value to the audience. If this is your first time tuning in, a huge thank you. Make sure you subscribe and share, the whole YouTube thing and notification bell. And I am responding to all comments. I do get comments on LinkedIn afterwards in the chat feature. So make sure that, if you have a question and you are shy and you don't even want to post it here, get your question in. And I thank you for taking time out of your busy schedules to join me. And wherever you are watching from, please, please, please do have an amazing day. And thank you. And I'll see you in a future live.